Hello everyone, welcome to the market opening bell on Friday, January 16th, your 10-minute guide to the stock market. After 4 consecutive gains, the Hong Kong stock market turned volatile and soft. The Hang Seng Index opened 27 points lower, briefly surged 207 points to a high of 27,206 and later fell 191 points to 26,808. In the afternoon, mainland China announced a 0.25 percentage point cut in various structural monetary policy tools and a 0.25 percentage point reduction in relending and rediscount rates starting next Monday. The market narrowed its losses, closing down 76 points or 0.3% at 26,923. The Asia Index fell 48 points or 0.5% to 9,266. The Hang Seng Tech Index dropped 79 points or 1.4% to 5,828. Total market turnover for the day was 290.4 billion Hong Kong dollars. Southbound funds net sold Hong Kong stocks by 1.515 billion. Among them, net buys include Alibaba at 1.976 billion, Tencent at 642 million, SMIC 180 million, Meituan 128 million, Hua Hong Semiconductor 114 million. Net sales include China Mobile at 791 million, Xiaomi 491 million, SMIC 365 million, Ping An Insurance 271 million, XTALPai Holdings 117 million. According to statistics, Southbound funds have net bought Tencent for 7 consecutive days, totaling 9.65 billion Hong Kong dollars. Net bought Alibaba for 4 consecutive days, totaling 4.38 billion. Net sold China Mobile for the 9th consecutive day, totaling 6.988 billion. Technically, the Hang Seng Index reached its target of 27,200 and pulled back but did not break the ascending flag pattern, with support at 26,600 on pullback. The 3 major Asia indexes fell in the morning and diverged in the afternoon, with turnover on the Shanghai and Shenzhen main board slightly declining to 2.91 trillion yuan. The Shanghai Composite Index fell 13 points or 0.3% to 4,112. The Shenzhen Component Index rose 58 points or 0.4% to 14,306. The Chinex Index rose 18 points or 0.6% to 3,367. The renminbi-US dollar central parity rate rose 56 pips day on day to 7.0064 per dollar, hitting a new high since May 18, 2023. The People's Bank of China announced that new renminbi loans in December 2025 totaled 910 billion yuan, significantly higher than November's 390 billion yuan and the market expectation of 800 billion, mainly due to the government's increased counter-cyclical adjustments, with new policy-based financial tools and structural tools driving credit extension. Full-year renminbi loan growth was 16.27 trillion, higher than the market expectation of 16.1617 trillion, but lower than 2024's 18.09 trillion, marking a new low since 2018. The full-year social financing scale increment was 35.6 trillion, up 3.34 trillion from the previous year, compared to the market expectation of 35.295 trillion. In December last year, broad money M2 grew 8.5% year-on-year, higher than the market expectation of 8% and November's 8%, mainly due to previous government bond financing converting into corporate and household deposits, maintaining reasonable and ample market liquidity. Narrow money M1 grew 3.8% year-on-year, with market expectation of 3.9%. Currency in circulation M0 grew 10.2% year-on-year. Full-year net cash injection was 1.31 trillion yuan. PBOC officials stated that there is still some room for RRR and interest rate cuts this year. In terms of the statutory reserve requirement ratio, the average RRR for financial institutions is currently 6.3%, so there's still room for RRR cuts. From the policy rate perspective, externally, the renminbi exchange rate is relatively stable. The US dollar is in a rate cutting cycle, and the exchange rate does not pose a strong constraint. Internally, since 2025, bank net interest margins have shown signs of stabilization, and in 2026, a large amount of 3-year and 5-year long-term deposits will mature. This reduction in various structural monetary policy to rates will help lower banks' interest payment costs, stabilize net interest margins, and create some space for rate cuts. In addition, the PBOC announced in the afternoon an increase of 400 billion yuan in relending quotas for technological innovation and technological transformation, bringing the total to 1.3 trillion yuan. Combined with TSMC's quarterly results exceeding expectations, chip stocks rebounded in the afternoon, with SMIC up 1.8% and Hua Hong up 6.3%. The People's Bank of China established the Technological Innovation and Technological Transformation relending in 2024 with an initial quota of 500 billion yuan. Subsequently, in accordance with the State Council's deployment, it decided to add 400 billion yuan, bringing the total relending quota to 900 billion yuan. This funding is mainly used to guide financial institutions to increase support for tech-oriented SMEs, key areas of technological transformation and the digital economy. The current interest rate is set at 1.75%, aimed at reducing corporate financing costs. Mainland China held a symposium for new energy vehicle industry enterprises, firmly opposing disorderly price wars, with some auto stocks rising against the market. It is understood that in addition to requiring companies to firmly oppose involution-style vicious competition, the symposium also clearly stated that it will strengthen cost investigations and price monitoring and intensify enforcement on market pricing behavior. Analysts believe that as disorderly price wars are controlled and talent plans accelerate their elimination, the core of industry competition will shift from pure price to capital strength, R&D innovation, and user experience. The overall industry profit margin is expected to enter recovery phase in the third quarter of 2026. However, starting in 2026, the vehicle purchase tax for new energy vehicles will be halved, with a maximum tax reduction of 15,000 yuan per vehicle, and manufacturers are required to stop blind price cuts, so total car purchase expenses will increase compared to 2025. How this affects car buying intentions remains to be observed. Xiaomi Auto's official Weibo announced the launch of a 7-year low-interest policy for the entire YU7 series, with down payments starting from 49,900 yuan, monthly payments as low as 2,593 yuan, and annual interest rates as low as 0.1%, starting from midnight today until the end of February. There is also a 3-year zero-interest option, with down payments starting from 74,900 yuan and monthly payments as low as 4,961 yuan. This move is a direct counter to Tesla China 7-year low-interest car purchase plan for Model 3 Y series. Launched on January 6, 2026, Xiaomi is seizing the SUV market share through a lower down payment threshold, 49,900 yuan versus Tesla's 79,900 yuan starting. Financial tools are better than direct price cuts in protecting brand premium and used car residual value, while effectively alleviating potential buyers' cash flow pressures. But long-term low-interest loans usually require subsidies from the automaker, which poses a test to Xiaomi Auto's early gross margin levels. Li-Ling announced that in the fourth quarter of 2025, Li-Ling points of sale, excluding Li-Ling Young, reached low single-digit year-on-year declines in retail sales across the entire platform. By channel, offline channels recorded mid-single-digit declines, with retail channels recording low single-digit declines, and wholesale channels recording mid-single-digit declines. E-commerce virtual store business remained flat. As of December 31st in China, the number of Li-Ling points of sale, excluding Li-Ling Young, total 6,091, a net decrease of 41 from the end of the previous quarter, and a net decrease of 26 year to date. Among the net decrease of 26 points of sale, retail business net decreased by 58 and by 59, and wholesale business net increased by 33. As of December 31st, 2025 in China, Li-Ling Young points of sale total 1,518, a net increase of 38 from the end of the previous quarter, and a net increase of 50 for the year. Li-Ling's fourth quarter data reflects that the Chinese sportswear market is still in a recovery phase, although the main board sales were slightly dragged down by offline traffic. The flat e-commerce channel and Li-Ling Young's counter-trend growth show the brand's resilience in niche markets. The market is currently focusing on the company's brand reshaping effects in 2026, driven by the Beijing Winter Olympics and various international events. Among mainland banks, CITIC Bank was the first to release a performance express, according to preliminary calculations under Chinese accounting standards at the group level. In 2025, facing a complex and changing internal and external environment, the bank made full efforts to promote high-quality development, with positive progress in strategic transformation and an upward development momentum. For 2025, the bank achieved net profit attributable to shareholders of 70.618 billion yuan, up 2.98% year-on-year. Last year's total operating income was 212.475 billion yuan, down 0.55% year-on-year. As of the end of 2025, the non-performing loan ratio was 1.15%, down 0.01 percentage points from the end of the previous year. Provision coverage ratio was 203.61%, down 5.82 percentage points from the end of the previous year. As of the end of 2025, the bank's total assets were 10,131.658 billion yuan, up 6.28% from the end of the previous year. Equity attributable to ordinary shareholders was 723.861 billion yuan, up 5.78% from the end of the previous year. By quarterly analysis, CITIC Bank's fourth quarter revenue turned positive year-on-year at 8.6%, a significant improvement from the third quarter, down 4.4%. Fourth quarter total assets grew 2.4% quarter-on-quarter, indicating increased credit extension at year-end. U.S. initial jobless claims unexpectedly declined last week, leading U.S. stocks to open higher and closed higher. The fear index fell 0.91 points or 5.4% to 15.84. The Dow rose as much as 431 points, closing up 292 points or 0.6% at 49,442. The Nasdaq rose 58 points or 0.3% to 23,530. The S&P 500 rose 17 points or 0.3% to 6,944. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, fell 46 points or 0.6% to 7,809. Bank stocks performed well, with Morgan Stanley fourth quarter revenue beating expectations. Wealth management revenue hitting a record high, shares up 5.8%. Goldman Sachs fourth quarter net profit up 12%, beating expectations. Shares up 4.6%. Citigroup up 4.5%. JP Morgan slightly up 0.5%. Chip stocks also rose, with TSMC quarterly net profit up 35% year-on-year, beating expectations. ADR shares up 4.4%. Nvidia up 2.1%, Micron up 1%. On economic data for the week ending January 10th, U.S. initial unemployment claims fell 9,000 week-on-week to 198,000, with market expectation of an increase to 215,000. U.S. President Trump hinted at possibly suspending military action against Iran, and the U.S. paused tariffs on key minerals, easing geopolitical and trade risks. Gold prices retreated from highs. Spot gold fell 0.4% to $4,607.1 per ounce. February gold futures fell $20.8 or 0.5% to $4,614.9 per ounce. March silver fell 0.2% to $91.24 per ounce. Oil prices fell over 4%. Our stock pick today is MicroPort Medical, stock code 853. MicroPort Medical is a Chinese domestically grown international high-end medical device group. Its industries fully cover multiple key areas such as cardiovascular intervention, cardiac rhythm management, orthopedics, and surgical robotics. Its innovative products have cumulatively reached over 100 countries and regions, serving more than 20,000 hospitals. The group's cardiovascular intervention business provides comprehensive treatment solutions for coronary artery-related diseases. After years of accumulation, the group's cardiovascular intervention business has completed the transformation from a single stent product layout to a comprehensive layout and product line integration across 6 major product directions: implantable devices, non-implantable intervention, access devices, active devices, imaging diagnostic devices, and critical care. It continues to refine its product layout around improving microcirculation and cardiac function during and after PCI procedures. The group's cardiac rhythm management business is dedicated to the research, development, manufacturing, and sales of products for diagnosing, treating, and managing arrhythmias and heart failure, primarily, including pacemakers, defibrillators, cardiac resynchronization therapy devices, and supporting leads, as well as complementary monitoring product combinations. The group's orthopedic medical device business provides comprehensive orthopedic solutions with products covering joint reconstruction, spine, trauma, and other specialized implants and tools. The group's surgical robotics business, MicroPort Robotics, is committed to addressing the forefront development needs of minimally invasive surgery, innovatively providing robotic intelligent surgery solutions that extend and reshape lives. It focuses on the research and development of 5 core underlying technologies for surgical robotics: robot body design, control algorithms, electrical engineering, image navigation, and precise imaging, differently covering the full life cycle of surgical robot development. MicroPort Robotics is the only company in the global industry with a product portfolio covering 5 major and rapidly growing surgical specialties, namely laparoscopy, orthopedics, panvascular, natural orifice, and percutaneous puncture surgery, and it will have opportunities to tap into the market potential of multiple surgical robotics subsectors, both domestically and internationally. By integrating relevant resources and leveraging its own overseas channels and experience advantages, the group has established a group overseas platform to help products approved within China quickly complete overseas market access and drive overseas sales growth. For the first half of the year ended June 30, 2025, the group's overseas business recorded revenue of $59.8 million, representing a year-on-year growth of 57.3%. Among them, surgical robotics business product sales grew 188.6% year-on-year. Neuro intervention business product sales grew 67.4%. Aortic and peripheral vascular intervention business product sales grew 95.2%, and structural heart disease business product sales grew 235.3%. In the future, the group's various sub-business segments will have more innovative products, leveraging the comprehensive and well-established distribution system of the global platform to efficiently, quickly, and comprehensively go overseas in groups, expand more business opportunities, continue to break into international untapped markets, and enhance the group's comprehensive competitiveness in the global market. Suggested buy price 11.8 Hong Kong dollars, target $13, stop loss $11.2. I do not hold the above stock.